Hey everyone, welcome back to my channel. In today's video, we're going to talk about the Vanguard Extended Market ETF, VXF. The Vanguard Extended Market ETF is one of the most popular ETFs that focuses on the US stock market. It provides investors with exposure to small cap and mid cap stocks, which are typically not included in the S&P 500 index. The fund aims to track the performance of the S&P Completion Index, which includes stocks from the S&P Total Market Index that are not included in the S&P 500. So, why invest in VXF? Well, small cap and mid cap stocks have historically outperformed large cap stocks over the long term. They have greater growth potential and can offer higher returns to investors. The VXF ETF provides investors with a diversified exposure to these stocks, which reduces their risk while still offering the potential for higher returns. Let's take a closer look at the fund's performance. Over the past 5 years, VXF has returned an average of 16.4% per year. That's a pretty impressive performance, especially when compared to the S&P 500 index, which returned an average of 14.6% per year over the same period. One of the biggest advantages of investing in VXF is that it provides investors with exposure to a broad range of companies across a variety of industries. This diversification reduces the risk of the portfolio by spreading the investment across multiple stocks. The fund invests in over 3,500 stocks, which ensures that no single stock has too much influence on the portfolio's performance. Moreover, VXF's low expense ratio is also a major selling point. At 0.06%, it is significantly lower than the average expense ratio for ETFs, which is around 0.45%. This low expense ratio means that investors keep more of their returns, which adds up over the long term. Now let's take a closer look at the fund's holdings. As of the end of June 2021, the fund's top 10 holdings were 1. Tesla Incorporated, 3.3%. 2. Nvidia Corporation, 2.4%. 3. PayPal Holdings Incorporated, 2.1%. 4. Zoom Video Communications Incorporated, 1.6%. 5. Advanced Micro Devices Incorporated, 1.6%. 6. Moderna Incorporated, 1.5%. 7. Square Incorporated, 1.5%. 8. CrowdStrike Holdings Incorporated, 1.4%. 9. Twilio Incorporated, 1.3%. 10. Shopify Incorporated, 1.3%. As you can see, the fund has a significant exposure to the technology sector. This is not surprising given that many of the fastest growing companies in the US are in the tech sector. However, the fund also has exposure to other sectors, including healthcare, consumer discretionary, industrials, and financials. Now, let's talk about the risks associated with investing in VXF. One of the primary risks is market volatility. Small cap and mid cap stocks are more volatile than large cap stocks, and as such, their prices can be more sensitive to changes in the market. Another risk is that the fund is heavily invested in the US market. As such, any changes to the US economy or political landscape could have a significant impact on the fund's performance. Lastly, investors should be aware that past performance is not indicative of future results. While VXF has performed well over the past few years, there is no guarantee that it will continue to do so in the future. That being said, I believe that VXF is a solid investment for investors looking for exposure to small cap and mid cap stocks.